The most expensive lie ordinary taxpayers believe is that if they did nothing wrong, they are safe. That sounds fair. It sounds civilized. It sounds like the way a decent system ought to work. It also happens to be a terrible way to prepare for an IRS audit, because an audit is not a morality play. It is not a courtroom drama where some brilliant government lawyer must prove you were wicked. It is not a philosophical inquiry into whether your intentions were pure. And it is certainly not a ceremony in which the IRS pauses respectfully to consider that you tried your best. An audit is much colder than that. An audit begins with a question. Can you prove it? That is the real question. Not was it legal. Not did your CPA say it was fine. Not did you believe it was ordinary and necessary. Can you prove it? And once you understand that, the whole emotional landscape of taxes changes, because most people spend their lives assuming the tax code is about what is technically allowed. That matters, of course. But in practice, once an audit begins, what matters just as much is whether the support exists, whether the records are clean, whether the documentation was created in real time rather than 3 frightened weekends after the notice arrived, whether the books speak clearly enough that a government employee with a checklist can see the boxes and mark them without needing to understand your soul. That is how audits really work. I do not say that to frighten you. I say it because I dislike mystery where structure exists. Mystery makes people emotional. Structure makes them useful. And the IRS, whatever else you think of it, is fundamentally a structure. A box-checking structure, a pattern-matching structure, a system that compares, requests, verifies, denies, and reverses far more often than it reasons romantically. The public likes to imagine the audit process as some rare dramatic event reserved for fraudsters, tax evaders, offshore schemers, cash under, the table operators, and people foolish enough to write off their dog as head of security. Those people exist, of course. But most of the pain I have seen around audits does not begin with cinematic criminality. It begins with ordinary sloppiness attached to technically legal positions. That is much more common. A person takes a legitimate deduction, a real deduction, a business expense that is, in fact, ordinary necessary and perfectly lawful. Then the IRS asks for support. The person has a bank statement, maybe a credit card statement, perhaps a vague memory, and a lot of emotion. The IRS reverses the deduction, not because the law prohibited it, because the taxpayer could not prove it. That is the central tragedy. And until you understand that tragedy, you will misunderstand what actually triggers audits, why people lose them, and what truly protects you. So let me say something bluntly: following the law is necessary. It is not sufficient. That is an uncomfortable sentence for a lot of people because they want the world to be simpler than it is. They want legality to be a shield all by itself. They want a system in which right action automatically produces safe outcomes. Finance rarely works that cleanly. Tax certainly does not. Tax is not only about law, it is about substantiation. It is about support. It is about the burden of proof. That burden, in the overwhelming majority of ordinary audit situations, sits on you, not on the IRS. That means the IRS does not begin by proving you wrong. You begin by proving you were right. That reversal is where most taxpayers get psychologically destroyed. They arrive in the audit thinking they are innocent until proven guilty. The system arrives thinking the deduction is unsupported until proven supported. Those are very different starting points. And if you walk into that mismatch unprepared, the result can become expensive, even when you were entirely within the law. I have seen this again and again. A business owner deducts software subscriptions, supplies, mileage, travel, contract labor, meals, and equipment. All ordinary enough, all plausibly valid. Then the IRS asks the simple, ugly questions. Where is the receipt? What was the business purpose? Where is the log? How does this tie to the ledger? Why was this trip primarily business? Who attended this meal? Why did this expense belong in this category instead of that one? What business activity generated this loss? Why should this activity be treated as a real business and not a hobby? If the records are organized, the experience becomes administrative annoying, but administrative if the records are weak. The experience becomes adversarial, even when the taxpayer insists correctly that everything was legal. That is the difference between being right and being provably right. Provably right is the only category that matters in an audit. Now, once you absorb that, the next logical question becomes what actually triggers the audit in the first place. And here again, the public loves mythology more than machinery. People imagine agents sitting around choosing targets based on hunches, grudges, or some intuitive sense that a person looks suspicious. Real life is much less cinematic. Returns are scored, patterns are compared, statistical deviations matter, checklists matter, losses matter, mismatches matter. The system is not really asking who seems like a bad person. It is asking which returns look sufficiently unusual that it is worth spending administrative effort requesting proof. That is a very different standard. and it is the reason so many honest people end up surprised. Honesty is not the screening variable. Oddness is. This is why I keep returning to the same word. Story: a tax return is not merely a pile of numbers. It is a story told in arithmetic, income, deductions, losses, depreciation, miles, home office, square footage, travel, meals, material participation hours. All of it forms a narrative. If the story is ordinary enough for the kind of taxpayer filing it, the return often moves on quietly. If the story is statistically loud, mismatched, or unusually favorable in a way the system associates with error or abuse, then the odds of inquiry rise. That is what people need to understand. An audit trigger is usually not one villainous act. It is a return telling a story that sounds a little too profitable, a little too neat, a little too loss heavy, a little too deduction rich, a little too different from what similar taxpayers normally report. And once the return is flagged, the question becomes not, did you mean well? The question becomes, can you carry the story under scrutiny? Let us start with the biggest trigger I see by far: losses. Losses attract attention because they contradict the basic economic expectation of why most activities exist in the first place. A business, in the government's eyes, is presumed to exist to make a profit. Now, businesses do lose money. Real businesses lose money all the time, especially when they are young, scaling, reorganizing, cyclical, or simply going through hard conditions. I have no objection to legitimate losses. The IRS does not either in theory. The problem is that losses are one of the fastest ways to make a return interesting, especially losses that offset other income. That is the critical part. A Schedule C loss that wipes out wage income gets noticed. A short-term rental loss that shelters other taxable income gets noticed. A real estate professional loss position with aggressive depreciation attached gets noticed. Large bonus depreciation deductions that produce dramatic paper losses get noticed. Any return where an activity appears to erase income from elsewhere begins asking the IRS to believe a more aggressive economic story than the average return tells. That does not make it illegal. It does make it visible. And visibility is the first problem. People often confuse visibility with guilt. They are not the same. You can take an entirely lawful position and still make yourself very visible. Many of the most powerful tax strategies work precisely because they allow legal reductions in taxable income that would look dramatic to anyone unfamiliar with the code. That is fine. But if you are going to take a visible position, you had better have invisible weakness nowhere. That is the rule. The stronger the tax result, the stronger the support must be. This is where hobby loss problems emerge too. If an activity shows repeated losses year after year, especially a smaller or less formal activity, the IRS may start asking whether this is really a business or simply a lifestyle being carried through a tax return. The distinction matters because once the activity gets treated as a hobby rather than a trade or business, the deduction structure collapses. The taxpayer is not merely denied current benefits. He can end up dealing with back taxes, penalties, interest, and the pain of discovering that years of casual treatment were never as safe as they felt. What protects you here is not your enthusiasm for the activity. It is evidence of profit motives, separate bank accounts, actual books, marketing, pricing, adjustment after bad results, attempts to improve a system that looks like a business instead of a pastime with receipts. The IRS cannot read your heart, but it can read your habits, and your habits either look like someone trying to make money or someone trying to make deductions. That is the first major trigger. Now let us move to amended returns asking for large refunds. This is one of those triggers people underestimate because they imagine amended means corrected and corrected means respectable. Sometimes that is true. Sometimes an amended return reflects a legitimate oversight, a late form, a corrected quan, or a real recalculation. Fine, but from the IRS point of view, a late return suddenly asking for a large check back is not merely a correction. It is a new event. It invites review because it changes the money after the fact. Again, story matters. A routine small adjustment attached to clear support is one thing. A large amended refund request built on some aggressive reinterpretation, newly discovered expense cluster, or strategy that suddenly appears after the original filing is another thing entirely. The larger the refund and the more dramatic the change, the more likely the system is to care. Then there are income mismatches. This is one of the dumbest ways people get audited because it is so easy to avoid. If a 1099 was issued and not properly reported, if gross receipts do not reconcile, if third-party information returns tell one story while your tax return tells another, the mismatch itself can create the problem. The government loves matching because matching is cheap. It does not require brilliance. It requires software. And software is very good at noticing when one institution said money moved and your return did not acknowledge that movement properly. Sometimes the taxpayer is innocent here. Maybe a form was wrong. Maybe it was duplicated. Maybe it reflected gross proceeds and not income. Maybe there was basis. Maybe the classification was different. Fine, but all of those explanations require one thing: records. That is the recurring answer, not outrage, not confidence records. Then we come to vehicle deductions, which are among the most common ways taxpayers accidentally invite scrutiny. Vehicles are seductive because people already spend money on them, which means the psychological temptation to make some of that spending tax efficient is enormous. And in many cases, business vehicle use is perfectly deductible. That is not the problem. The problem is how quickly people begin stretching the facts. 100% business use on a vehicle that is obviously also a personal vehicle. Weak or non-existent mileage logs, travel descriptions created after the fact category inflation. Standard mileage claimed where records are too thin to support the trips. Actual expense methods used sloppily. These are not exotic problems. They are routine. The IRS knows it. What matters in a vehicle audit is not whether you love your business. It is whether the miles were logged, the purpose was documented, and the claimed use matches the reality of how an ordinary person in your situation would have lived. A car deduction without a mileage log is often just a story with gasoline on it. That is not enough. Bank statements are not enough either. People love waving a card statement showing that they bought gas. Fine. That proves they bought gas. It does not prove where they drove, why they drove there, whether the trip was business, whether the trip was personal, or what proportion of the total use was actually deductible. That is why I say statements prove that money left. They do not prove why it left. That distinction runs through almost every category in an audit. The same problem shows up with meals. Business meals are legitimate in the right circumstances. I have no quarrel with that. But a meal deduction is not created by the mere fact that somebody ate while also possessing business ambitions. The meal has to be tied to actual business purpose. Who was there? What was discussed? Why was the expense ordinary and necessary in carrying on the business? Was the amount reasonable? Was the deduction limited appropriately? Were receipts kept? Was the purpose documented while the event was fresh? Without that, a meals deduction quickly turns into a suspicious pattern, especially when the total looks large relative to income. If you make $60,000 and claim an eye-catching amount in meals, the system is going to notice because statistically that begins to smell less like occasional business development and more like lifestyle absorption. And again, this is where many people make the fatal mistake. They think, but the dinner really did happen. Good. The IRS is not mainly questioning whether you swallowed food. It is questioning whether the deduction survives the checklist. The checklist wants support. Now let us talk about home office deductions, because fear around this area is often misplaced. A legitimate home office is not inherently a red flag. The public has been frightened for years into thinking the deduction itself is suspicious. That is not really the issue. Home offices are common. Many businesses are genuinely run from home. The real problems come from exaggeration and poor support. Huge portions of the House claimed multiple businesses trying to use the same office beyond credibility. Spaces that are not used exclusively for business. Square footage estimates that seem untethered from reality. The strategy is not the problem. The mismatch is. I like that distinction because it is true in so many areas of tax cost. Segregation is not automatically suspicious. Home office is not automatically suspicious. Large depreciation is not automatically suspicious. Short-term rental strategies are not automatically suspicious. The system does not hate strategy. It hates unsupported strategy. An unsupported strategy is not planning. It is risk dressed in expensive language. That brings us to real estate professional status and short-term rental loss positions, where the law can be generous, but the support burden is severe. If you claim active treatment, material participation, or non-passive classification in a way that offsets other income, you are effectively asking the government to believe a very specific factual narrative about how you spent your time and how the activity was managed. That means hours matter, logs matter, contemporaneous records matter, entity structure matters, your day job matters, your calendar matters. Everything has to line up. This is where people who took a strategy from the internet often get destroyed. They hear the headline benefit and assume the implementation can be improvised later. Then the audit comes years afterward and they start trying to reconstruct time, participation, and business activity from memory. Memory is weak evidence. Courts know this, the IRS knows this. Taxpayers discover it too late. Documentation built during an audit is treated very differently from documentation built when the event happened. That is one of the coldest truths in the entire process. If you create the log after the notice arrives, it carries far less credibility than if the log existed before anyone asked. Courts have language for this. They do not love self-serving reconstruction. And why should they? Everybody remembers life more favorably when money depends on the memory. That is why timing matters so much. If the support is not created while the business is actually living, it often becomes much weaker when the government comes asking. This is also why I think people misunderstand what protection really means in tax planning. They think protection means having a smart CPA that helps. They think protection means taking conservative positions. That helps too. But the deepest protection is an accounting system that captures the business reality as it happens. Receipts tied to transactions, business purpose attached in real time, clean ledger, separate accounts, actual books, traceability. That is what protection looks like, not brilliance. Infrastructure. The person with infrastructure does not need to become eloquent during an audit. He needs only to produce, and production is much cheaper than argument. That is especially important because many audits today are not even grand full-scale audits in the dramatic sense people imagine. They are correspondence audits. A letter arrives. The IRS asks for support. The taxpayer mails in what he has. If what he sends does not satisfy the request, the deduction gets reversed. There is very little emotional theater in this. The government does not need to defeat you in debate. It merely needs to decide that what you sent failed the checklist. Then the burden shifts to you to keep fighting. That is expensive even when you ultimately win. People do not appreciate this enough. They talk about audits as if the only outcome that matters is whether the tax gets assessed. That is too narrow. Audits are costly in time, energy, attention, advisor fees, record reconstruction, distraction, and emotional drag. Best case scenario in many audits is not that you make money. It is that after months of effort you end exactly where you started. That is why I say the real goal is not merely to avoid an audit. The real goal is to be able to fly through one if it happens. That is a better objective. Because once you accept that audits are not always random and not always avoidable, the rational move is not panic. The rational move is preparation. Preparation means organized documentation. Preparation means real accounting systems, not shoeboxes, not vague spreadsheets, not year-end archaeology. Preparation means understanding that a receipt is not optional decoration but one of the key pieces of proof the system expects. Preparation means understanding that a bank statement is not a substitute for support. This is one of the most important distinctions in all of audit defense, and yet almost nobody teaches it well. A bank statement or credit card statement proves that money left your account. It proves a transaction occurred. It does not prove what was purchased in the way an itemized receipt does. It does not prove why the expense was business related. It does not prove the business purpose. It does not prove who attended. It does not prove whether an item was capitalizable, deductible, personal, mixed use, or misclassified. It is evidence of movement, not evidence of characterization. That is why businesses with immaculate statements still lose deductions. They can prove they spent. They cannot prove what the IRS needs beyond that. Now let me give you the cleanest framework I know for understanding all of this. There are 3 layers. The first layer is law. Is the position legal in principle? The second layer is trigger. Does the return become interesting because of losses? Mismatches, refund claims, unusual deductions, or other visible signals. The third layer is fix. Can you produce clear documentation quickly enough and cleanly enough that the audit becomes administrative rather than combative? Most people obsess over the first layer because it is intellectually flattering. They want to know the rule. They want to know if something is allowed, fine, but the real-world pain often lives in the second and third layers. A legal deduction can still be a trigger. A triggered return can still be fine if the support is beautiful. An illegal position is obviously bad, but a legal position with no support is often almost as expensive in practice. That is the truth nobody likes. And because nobody likes it, they keep overpaying for comfort on one side and underinvesting in records on the other. I would rather tell you the plain truth. The IRS is a box, checking system. The goal is to make the boxes easy to check. That is not poetry. It is just useful. If the ledger is clean, the receipts are attached, the business purpose is recorded, the participation logs are current, the travel records are coherent, the categories make sense for the industry, and the return tells a story that matches the facts, then you have made the government's job much easier. Ironically, that often makes your life much easier too. The less imaginative effort the examiner must exert, the better for you. What creates danger is not only aggressive strategy, it is friction. A messy file, ambiguous purpose, unsupported categories, explanations built from memory, reconstructed logs, personal and business transactions mixed together, receipts missing. A ledger that does not really reconcile. A taxpayer who says, trust me is not a tax defense. That is why I always tell business owners the same thing. If your planning is just ideas without implementation and support, it is not planning, it is risk. Real planning is boring in the right places. The return is thoughtful, the books are clean, the receipts are accessible, the purpose is documented, the losses, if they exist, are supported by real profit motive and business conduct. The categories make sense. Nothing heroic is required when the notice comes. That is what winning looks like, not emotional victory preparedness. So what actually triggers an IRS audit? Not one thing, a story that becomes interesting enough for the system to want proof, and what actually protects you, not belief in your own innocence support. That is the whole game. Once you understand that, audits stop feeling mystical. They start feeling mechanical and mechanical systems once understood become much easier to survive.